So I can confidently say most of our client conversations start off with, are we in an AI bubble? And I think the way we, at Wellington, think we might have an edge in answering this question is really looking across the capital structure. And so I try to think about, if we were in an AI bubble, what would be the signposts of what we would see? And the number one thing I would say is, all these companies are able to just sail through the capital markets doing really risky things, really risky financing, projects with no returns, funding it with debt, and the market not pushing back at all. What we've actually seen over the last 6 months, interestingly, is sort of the opposite. So you've seen deals in the high yield markets that actually haven't been able to be done. You've seen a lot of convertible issuance from companies that are actually using that to recapitalize their balance sheets. So some of the neo cloud providers, their credit spreads weakened materially. They realize we still need access to the bond market, so we're going to have to go and raise equity or quasi-equity in order to recapitalize our balance sheet and give the market more strength in our credibility. In the investment grade markets, you've seen a couple companies' credit spreads sell off really materially, and we're starting to see kind of these companies realize, okay, this is a multi-year investment cycle. We're probably in the second or third inning of this game. In order for this to be sustainable, we need to approach this from a very disciplined perspective. And so, certainly we could have sell-offs in the equity market, the credit market. Markets don't move in a straight line, but when I think about, are we in an AI bubble? I'm already seeing signs of discipline in various different parts of the market that tell me it's probably not today's issue. I might take a step back and just start with kind of the environment that we're in today. And so equity multiples are high, fixed income yields and corporate yields are high. And so that has kind of one obvious implication for investors and clients, which is the prospective forward returns for fixed income are likely to be appealing relative to equities, because both of these markets sort of mean revert. The other implication, and this is more nuanced in terms of from a corporate perspective, is when corporations look at their capital structures, the fact that equity multiples are high, that means the cost of equity financing is relatively low. The fact that corporate yields are high means that cost is relatively high. So what we've seen from corporate America is they're being a little bit more nuanced. Typically, when you think about the public markets, companies can issue stocks and bonds, and people don't think of anything in between. What's really interesting over the last couple of years is there's been growth of what we call the hybrid capital markets, which I would include corporate hybrids, preferred stock, and as you mentioned, convertible bonds. And so, for example, one reason a company might issue a convertible bond, it allows them to issue at a much lower interest expense because they're also basically selling the investor an equity option. So there's a very good reason why this makes sense for the issuers. It can also make sense for investors, and this has been a popular trade for us over the last 12 to 18 months. When you get into a tight credit spread environment, you think about credit, there's not much price appreciation. When you look at something like the high yield market, you look at the convexity of the high yield market, it's basically the most negatively convex it's been ever. And where does negative convexity come from? It comes from the fact that you're short an option to an issuer. So you have a high coupon, their funding costs has come down, they're going to call you away whether things go well or go poorly. You contrast that to convertible bonds where you actually own an equity option in the company and you have the chance of positive participation if things continue to do well. And so we really like adding things like convertible bonds to a credit portfolio because it allows you to add some optionality to the portfolio if we continue to have this positive environment. So if you look at a year like 2025, convertibles were by far and away the best performing credit asset class, and they bested their peers basically by the highest level that we've seen over history. I'm not sure they can continue to do that going forward, that level of outperformance, just given where equity multiples are, but we still continue to like the positive convexity because we think it's a nice way to participate in what we see as still a strong macro risk environment.